Good morning, Hong Kong, and welcome back to another episode of Hong Kong Insurance 101. This week, we're looking at indemnity, what it is, and how it applies to your insurance products. Indemnity is at the core to many types of insurance coverage and is defined as the exact financial compensation of an insured loss. Under the concept of indemnity, the compensation provided to offset any financial loss must be the exact amount of that loss, no more and no less. Simply put, with indemnity, the policyholder will receive compensation for the exact amount of any financial loss they may experience, subject to policy terms and conditions. Now, in Hong Kong insurance, indemnity is normally settled in one of four ways. Firstly, through a cash payment. This is where the policyholder would receive a simple cash payment for the value of their loss. Second would be to repair. So this is more common in things like car insurance, where the insurer can indemnify the policyholder by repairing their vehicle after an accident. Fourth would be replacement. So instead of repairing, the insurer is simply going to replace the entire loss for the policyholder. And fourth is reinstatement. And there's significant overlap between reinstatement, replacement, and repair, because reinstatement means to turn the loss exactly as it was prior to the accident. Although indemnity is defined as exact financial compensation for an insured loss, many insurance policies will include terms and conditions that mean that an amount less than full indemnity is payable following a loss. Some terms which will appear on your policy which will limit full indemnification of your claim and which are important for you to understand are things like average. So for most non-marine policies in Hong Kong, they will be subject to the principle of average. Under this principle, the insurer expects any policyholder to insure their property up to its full value. If the property is not insured up to its full value and a loss occurs, then the claim payable will reduce in proportion to the underinsurance of the property. Let's say that a fire insurance policy is covering a home worth $4 million, but the policyholder has only insured it for $1 million. Under the concept of average, the property was only 25% insured, and consequently only 25% of the loss is covered. Underinsuring your property and possessions may achieve significant premium savings, but will expose you to significant stress and ensure that you do not receive full indemnification in the event of a loss. Another area that would impact the ability to receive full indemnification under your plan would be deductibles. And this is a major modification to receiving full indemnification. A deductible is the monetary amount that you will contribute towards the cost of any claim, with the insurance company covering the remaining balance. A deductible is always deducted from the claim settlement and can normally be found on products like health and motor insurance. Using motor insurance as an example, if a car insurance policy has a $5,000 deductible and the policyholder experiences a covered loss of $10,000 to their vehicle, then the insurer is responsible for paying $10,000 of the claim. For a claim under $5,000 in value, the insurer would have no liability and the policyholder would be responsible for paying the loss out of pocket. Indemnity is a critical component of insurance as it impacts what you will receive following a loss. Under the concept of indemnity, a person should be able to recover what they have lost. In practicality, there are a number of mechanisms and contractual obligations that may limit your full indemnification following an insured loss. That's us for this week. As always, we hope you have a healthy and happy weekend. Remember to like and subscribe to stay current with all our content as it comes out, and don't forget to ask CCW. We're simplifying your insurance.